some of you are asking the question, how much more of Anglo can we take? But I am bearing in mind that we have a mixed audience. You know, some of you will be very familiar with the scenes and sites that will be appearing in front of you, and indeed some of the horrendous figures will be already in your minds. But to others, you may be somewhat familiar with the Irish financial crisis and indeed with Anglo-Irish Bank, but only to a limited extent. Now the photograph in the background kind of depicts itself. It's the well-known former headquarter building of Anglo-Irish Bank, or the bank formerly known as Anglo-Irish Bank, on St Stephen's Green in central Dublin. And if only the over €30 billion losses could be removed so easily. But this brings me to the key point of this paper, which essentially is to raise the importance of telling a story about Anglo that sits within a broader context. In other words, to internationalise the case of Anglo. So we've heard stories of, for example, the case of Narvik in Norway, and how the municipality invested huge volumes of its resources in securities and lost massive amounts. But what about Anglo? How can we internationalise the case of Anglo, speak to a more international audience? So there are some driving questions behind this paper. Firstly, where do we situate the Irish crisis, the Irish financial crisis, and indeed Anglo within that, as a particular institution within the broader context? Where do we begin our investigation? What theoretical frameworks do we use? Do we start with understanding and tracking the global processes, structural forces, state action, the relationship between state and markets, increasingly blurred relationship? What about regulatory systems, their multi-scaled nature and how they interact, institutional actors, or do we follow various cultures and practices? Now, recent accounts of the Irish financial crisis tend to accentuate the role and actions of local institutions, of local actors, of local practices and cultures, and tend to spend very little attention on understanding the multi-scaled nature of regulation and of segmented international capital flows and multi-directional influences. So we need to bridge that gap, start to situate particular cases within that broader framework. Another driving question, or general question, is how and where do we situate experiences of peripheral places within the international financial crisis? So, as Darius mentioned in the previous paper, a lot of the discussion, a lot of the international commentary tends to start with the case of the mortgage securities crisis in the US and how it spread from there to other core areas, particularly into Europe. But there are many stories to be told and imparted that reveal the complex nature of the financial system. And one of the key features of this crisis, of course, is its highly differentiated geographies. Even within the Eurozone crisis at the moment, if you think about it, while the financial system is interdependent, it's transnational, the crisis is unfolding on a country-by-country basis. It's unfolding on a consecutive basis rather than occurring simultaneously. And so why is that? To follow on some of those questions. And also then, this question of the global and the local. Not as a binary, not to be viewed as a binary or oppositional concept, but rather as a dialectic or relational, relational tendencies. So should we try to differentiate global and local processes, bearing in mind that there are these relational tendencies? It can become quite confusing, quite fuzzy in the overall theatre within which new financial innovations or new financial regulations take place or are forged. So what I'd like to do in this paper is firstly to have a quick look at the multi-scaled regulatory contexts that facilitated the emergence of a colossal financial bubble in Ireland. And then to examine the role of local financial institutions in acting as mediators within that global financial system. So Anglo is going to be the focus of this, a case study within a case study, essentially. So we look at the global and local credentials of Anglo-Irish Bank, a place-based institution with its own set of practices, but an institution which is integrated into global financial markets, and an institution with a firm commitment to large-scale speculative real estate investment. A number of different particularities associated with this. I will also very quickly point to how Anglo itself was actively involved in evolving and indeed influencing the local regulatory context itself. Okay, just to situate this paper theoretically, probably slightly different to papers that we've heard already today, but I think it's really illuminating to draw on Harvey's ideas of theories of overaccumulation on the finance form of capitalism, and in particular to look at and consider the crisis of capitalism as a problem of surplus absorption and overproduction. So in a very simplistic explanation here, the key antagonism which Harvey identifies is the requirement of capitalism, or within capitalism, to generate ever and greater faster returns through the expansion of production. But then in turn, the pressure to increase profit generates the pressure to decrease wages, which serves to reduce aggregate demand. Now, over the past 30 years, that pressure to decrease wages and thus decrease aggregate demand has been met through a massive expansion of credit. But eventually, of course, that credit has to be paid off, and this is where we're at the moment. So this building up of capital, desperately seeking profitable outputs, and you often hear of the concept of that there's this great weight of money desperately seeking profitable outlets. And what we've seen in recent decades has been a massive shift of capital on surplus into investing in asset values rather than in production. And that, of course, has to be accompanied by financial innovation. So I'll come back to some of these points towards the end. And of course, just to situate it more broadly, then we've had a plethora of research works in the area of financialization and comparative political economy. Darius's work definitely is situated in here. You see a lot of work documenting the increasing significance of financial institutions and activities in political capitalism, the increasing prevalence and power of financial intermediaries, of financial innovation and engineering, and also financialization as an increasingly dominant mode of corporate governance. So these are the literatures and the theories to which, more generally, this paper speaks to. Okay, getting to the multi-scaled and multi-directional regulation. So this is just an extract of the various scales at which regulation of the financial system takes place, and as it has influenced the regulation of the financial system in Ireland. Now, while it's in a tabular format going from international to European to Irish, it doesn't necessarily infer that it's a very hierarchical relationship among these scales. But the overarching context, of course, is the increasing mobility of capital flows and the deregulation of the financial system through the 1980s. This is Thatcher and Reagan. But we can look at how the changes in regulation and practice had very significant and severe impacts in the case of Ireland. So from the international, from the Basel I and II arrangements, which in practice decreased capital liquidity ratios and also encouraged self-regulation of the system. At the European level, with the European Monetary Union and European Central Bank policy, it encourages and sets in motion low interest rates, low inflation and supply-side interventions. And of course, in the Irish system, these are just a couple of examples, the Irish payment clearing system allowed the entry of international banks to operate in the Irish financial system. And of course, we had the adoption of principles-based regulation, so a mode of regulating the system is essentially self-regulation by the banks themselves, which of course laid the platform for very dodgy kinds of activities taking place within Irish banks themselves, the traditional banks. And the overall impact of each of these, at each of these scales, is massive credit expansion. And we'll document some of that expansion in relation to Anglo in particular. Sound effects there, just in case any of you were nodding off. Right, the institutional context then. Some of these policy changes within a very short period of time led to a transformation in the financial sector. So in particular, the entrance of non-Irish banks to the Irish banking system, such as Halifax, Rabobank, Northern Rock, Danske Bank, and Royal Bank of Scotland, had a major impact, particularly in relation to mortgage lending. It forced down, Halifax in particular, forced down the residential mortgage lending rate, and immediately has a transformative action on the actions of the other banks, because they too, if they were staying in, are forced to decrease their margins. And of course, they were increasing the volumes of which they were lending. Another aspect of internationalization then is the increasing international activities of the domestic banks. So in particular, AIB, Bank of Ireland, and Anglo I'll mention in a moment. Not just for lending purposes, say, it's well known that these three institutions were very active in lending against property in the City of London, for example. But importantly, they became involved in acquiring international banking operations, subsidiaries of other banks, in order to provide a deposit base from which they could leverage further lending, often back in Ireland. So this is an important element in transforming the model, and of course it's linking the global and the local. It's linking internationalized deposits with the local property developments in Ireland. And of course you had the increasing prevalence of interbank lending, particularly from about 2003 onwards, and that was ratcheted up in 2006, very telling year, which I'll get to in a moment. So mortgage lending policy, so this leads on then from internationalization to innovation, where you have quite incredible policies in relation to mortgages. 100% mortgages became the norm in the 2000s in particular. The duration of mortgages typically over 30 years, interest rates typically less than 4%, and larger income multipliers were allowed for. That sometimes, particularly those of you who are based in Ireland, you've heard this. It's been ongoing for the last 3 years, but it's truly remarkable, the mortgage lending conditions when you compare across European countries, neighbouring European countries. And the income multipliers were astronomical, so sometimes typically around 10 times income allowed. So importantly, you have this revolutionary role of smaller banks and building societies. So Anglo, the Irish Nationwide Building Society, and the EBS Building Society were crucial in revolutionising what the bigger traditional banks were doing and how they operated. The smaller institutions tended to target specific clients, so they would target a small number of big clients and lend large volumes of money to them. And the more traditional banks, the bigger banks which have large branch networks, they themselves, following on the coattails of Anglo in particular, set up teams within their own institutions in order to adopt the Anglo model of lending. So this acts as a catalyst or pressure for institutional change in larger banks. And of course the overall story, the overall impact is this massive credit expansion. And of course, as we know, a lot of that was linked very strongly to property. Okay, then we get to local institutions. Institutions with their own sets of experiences and practices. And here, what I'm hinting at is how local institutions mediate these global flows of capital. Ultimately, the national context or the local policy context is crucial in determining the scale, the flow, the intensity of flows of capital and where they find expression. The management and organisation model of Anglo Irish Bank, which was a relatively small institution up until the 1990s, and within 10 years was competing with the two largest banks, Allied Irish Banks and the Bank of Ireland. And it had a very different organisation model. It's a personnel-based business, so offering high-level management to a specific client base. It focused and targeted elite networks, so linking global capital to local projects, so it could access deposits or indeed interbank lending facilities and link it up to property-based projects, such as, for example, the Docklands, well-known documented case in and around the IFSC area. So it almost had this pre-prepared projects ready to go. So once it had, it could align itself with developments, developers, and all the other intermediaries. It could link up lending to those ready-to-go projects. As well documented by Simon Carswell in his recent book, Anglo Republic, goes into a lot of detail and documents quite well how the loan approval system was very much fast-tracked, and that speed at which loans were approved ratcheted up as you go into the 2000s, 2005, 2006, crucially. Loans, they were of course increasing in scale as well. So small number of clients, but the volume, the size of loans that were lent out increased very, very rapidly. And this, of course, this model explains its growth, but it ties it into its downfall. Its core business operations, then I won't say much about, tended to focus on bank lending. Bank lending was its staple too, but it had a very specific model. Treasury became increasingly important in the 2000s, and wealth management. So it had quite an institutional differentiation, had its own mark. Focus on certain clients, lending to a small number of borrowers with a good track record. And this tactic is not unusual. Susan Feinstein in the cities of New York and London in 1996 documented where you had similar approaches by smaller banks following property developers in many cases. But it's the scale of Anglo's expansion which is the key feature in this story. So Anglo as a mediator, how can we understand, or can we understand Anglo as mediating between the global and the local? Well, it's very much integrated into global financial systems, and it became increasingly so into the late 90s and into the 2000s, where it bought up operations, banking subsidiaries in the UK, in the Isle of Man, in the US, and in Austria. And this purchasing of banking operations in other countries facilitated not just lending operations there, but more importantly, it gave it a deposit base from which to leverage much larger volumes of lending, mainly in Ireland, mainly in relation to its property development. Its interbank borrowing and this selling of bank bonds increased dramatically from around 2003. I'll show you graphically what was happening in just a moment. But as the international system was approaching crisis in terms of the financial system, the activities that Anglo was operating under were becoming increasingly volatile, increasingly risky, and they were increasingly bound into continuing the same model that had generated so returns before. Anglo was very much involved in mediating the regulatory framework. So the previous table that I showed you, as I mentioned, it's not necessarily hierarchical, and it also is not necessarily concrete. So there was plenty of wriggle room in relation to the rules that needed to be applied and where they could be bent or even broken altogether. We see that in relation to the degree to which Anglo required a certain amount of lending per client. So it not only had this 1% of total assets, this was the maximum that it could lend out to one individual, and it frequently broke that principle. And of course, towards the end, you can see how it was concealing crises. But it was linking capital flows directly into the built environment. So it could use its deposit base in other countries and link it, find expression of for those flows of money in the built environment. Story of property development. Okay, so getting back to some of the images and the sites that some of you will be familiar with. The two characters here, Sean Fitzpatrick and David Drumm. The CEO, of course, Sean Fitzpatrick, very much associated with the development of the bank, and his successor, David Drumm, in 2005, he was appointed. But just to give you an idea as to the scale, this is really just to highlight the scale of growth. 38%. The important thing to note is the scale at which Anglo grew on a yearly basis. It was delivering profits for 22 years, but return on equity is 30%, exceptional growth in customer lending, it's an interesting one, of in 1 year, 15.6 billion, up 45%. What it doesn't show is the exceptional growth in interbank lending and the sale of bank bonds at the same period, and it ramped up even further in 2007 and 2008. So there's an increasing gap between this deposit base and the amounts that was lending out. And of course, it reached that gap through interbank lending and sale of bonds. Yeah. So Anglo's meteoric expansion. The graph just highlights the increase in customer loans, and it's very clear from the reports, Anglo's annual reports, that the expansion of its credit book was equated with success. So the extent to which the volume of loans that it was lending out, it was a very simple equation. That was its measure of success. And you can see quite clearly from 2003 the scale of lending absolutely balloons. In 2006, it was sanctioning loans of, again, from Carswell, of over €1 billion per month for a small bank, a small operation. 22 years of profits, consistently high shareholder dividends, but increasingly the customer loans are not underpinned by deposits, they're underpinned by short-term borrowings in the form of interbank lending and bank bonds. So Anglo's collapse, so just to highlight the scale, posted losses of 34.4 billion between 2009 and 2010. Probably has increased, will increase more, which represents, just to emphasize the scale, more than the national annual tax take. And this is not the biggest bank, this was a relatively small bank. And of course, that debt, those losses have been transferred to state and society more generally. And that remains to be seen what the full amount actually is. Customer deposits plunged. From 51 billion to 11.1 billion and falling. And of course, Anglo has been, in its official capacity, wound up and is in the process of being wound up. And desperation tactics deepened those losses. So there was the process of scrambling to try just one more bet, and surely that would save the bank. And of course, it deepens the crisis during the crash. So you had this strange appearance of €7 billion from a permanent TSB bank. So another bank was lodging deposits into that bank, so it appeared to have a larger deposit base than it actually had. Okay, it's important to contextualise the case of Anglo within broader international financial systems. Obviously, Anglo-Irish Bank, it wasn't operating simply in an Irish context. It had access to the availability of services seeking profitable outlets. And that story needs to be told. The scale of the Irish financial bubble and losses is an important story in the international financial crisis. It's important to internationalise that case study. But it's not associated with sophisticated financial innovation or complex risk distribution models. It's much more traditional. It's much simpler in many ways. It's associated with property and outlet. It carries an inbuilt risk premium. But once Anglo became tangled up with committing to a key base of key clients, then to pull the plug on lending would in itself have led to a run on its own resources. Global processes mediated by local institutions, can't say too much about this here, but I will in the written paper. Money flows like mercury. Local institutions are still key, they're crucial in determining the intensity, the scale of flows, and ultimately where it goes. And the local has the potential to control some of that. It used to, in the 1980s, have examples where pension or Irish investment funds, they had controls over them. Only 10% of Irish investment funds could be invested abroad. So they do exist, but there's not that story, those kinds of issues, they're not being talked about, they're not even being discussed in this overall context of the financial crisis. But it is possible, it has been in the past, to control flows of capital, at least to some extent. And final point then, the crisis remains, just again to recover what Darius said. We see this shifting, these shifting geographies, shifting sectors, and the shifting distribution, which is probably the most important impact, that again receives relatively limited attention. Just one quick concluding point, well, just having read an article that came out of Davos, the World Economic Forum, I think it was like 8 of the world's biggest financial institutions have racked up between losses and costs of states bailing them out in the region of $2 trillion. So there's a whole redistribution taking place there, a useful statistic on a global scale that we need to keep track of. And it links back to some of Darius's questions about places like the IFSC and how they should be maintained. But what about the broader questions of such a massive, colossal redistribution of resources in order simply to maintain the current financial system? So I'll